Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Over the past 2 decades, we've seen our fair share of economic volatility. Between inflation, recession, and geopolitical upheaval risk, adjusting your portfolio can be a daunting task. One asset class that historically has served as a consistent hedge against this uncertainty is farmland. Investors, myself included, have been interested in farmland on account of its historically stable track record in the face of rapid economic change. Between 1997 and 2022, we've lost approximately 4.8 acres of cropland per minute to urbanization, while this same expanding population needs the food, fuel, and fiber farms produce. So why aren't more considering farmland? Access. Purchasing a farm costs millions of dollars, and working with local farmers takes time and agricultural expertise. AcreTrader provides investors passive access to farmland with investment minimums of only $15,000. Learn more about investing in farmland with AcreTrader. Investments in private placements are illiquid, speculative, and may result in the complete loss of capital. Securities offered through NCPS, member of FINRA SIPC. Welcome back, everybody. Happy holidays. Today, we have one of our favorite guests for his 3rd time on the show, joined by Rick Rieder. Rick is the Chief Investment Officer of Global Fixed Income at BlackRock. He also heads the fundamental fixed income business and the global allocation investment team. Rick, welcome back to the show.
Thanks for having me. I appreciate it.
We were just chatting on the beginning, and I said, what's there to chat about? It's bull market, all-time highs, everybody's fat and happy. It's going to be a lot of presents under the tree. Is that the way it feels? What's going on in the world? Is everyone just going to toast some champagne and enjoy the new year? What's it look like?
By the way, there's a short transition between, it's amazing in the markets, like everything goes to year end, like you like charge hard, and like there's not really a difference, shouldn't be a difference between this month and next, but it is incredible how the markets do that. It's like, I just want to get to the end. I just want to get to the end. And and by the way, in the markets, it feels like that today. Liquidity is not great. You get aberrational moves in some names. I have to say, in November felt worse than it ended up being. There was a lot of volatility. It ended up, the equity market ended up in the black, bond market ended up in the black. And if you took the month off, sometimes I feel like that would have been good. But if I took the month off, you come back and say, yeah, it was okay. But it was some hand-wringing times during November for sure that, it's part of, I've learned over the years, it's like cleanses them. You need a bit of a cleansing.
There's something about year-end, decade-end that sort of marks passages, the end of the late 90s, the millennium. I don't know what the Japanese bubble into the 80s. It feels like there's something about just year-end. I 100% agree with you. There's nothing magical about year-end, but for some reason, the passage of time, on this strange calendar year we have, it seems to mark these type of turning points. I don't know. Maybe it's just the astrologer.
No, but by the way, it's a pretty extraordinary market evolution about how that, like the liquidity in November, December shouldn't be the case, is generally October through December, not good. And then all of a sudden, January, everybody's ready to go. It makes no sense that it's set up that way, but it is. And there is some reality to it. We see this with pension funds, insurance companies. They get a bunch of money at the beginning of the year and they put it to work. New issue goes higher or is dramatically higher. Markets tend to do well when supply is coming. It verifies, here's where levels are. And then October through December, it's just, and by the way, it's a lot of, including this year, it's a lot of protecting the year. And like, you know what, I'll just step out. And, you see these aberrational moves.
There's a quote that it just reminded me of. We were talking about champagne, and it's from a book that was published before I was born. So listeners, if you have not read this book, it's one of my favorites. It's worth a reread. Adam Smith's The Money Game. And I'm going to read you this quote as we sit here at all-time highs in the stock market. And it says, "We're at a wonderful ball where the champagne sparkles in every glass and soft laughter falls upon the summer air. We know at some moment the black horseman will come shattering through the terrace doors, wrecking vengeance and scattering the survivors. Those who leave early are saved, but the ball is so splendid, no one wants to leave while there's still time. So everyone keeps asking, what time is it? But none of the clocks have hands. I love that book. Have you ever read this old school? I know you're a big reader. That's an old school one. Most listeners probably never heard of.
I have it. That, by the way, that quote's pretty good. Like that is that base and feels that way.
I love the imagery of one of your quotes where you talk about this romping, stomping equity market. We'll stay on for a minute, where you talk about companies and some of these big ones and the just rivers of cash flow. I feel like that's such a good descriptor. Talk to us. Are these companies still unleashing the dam? Is it slowing down to a trickle? How are you feeling about the broad market?
By the way, the fast rivers of cash flow. I've been doing this. I'm about to my fourth decade. I still can't believe it is the case, but I've never seen anything like it at this scale that these companies can create this sort of top line revenue growth, this sort of return on equity, and throw off free cash flow of this size. So, free cash flow is like the lifeblood of any company. Because if you have free cash flow, you can spend on CapEx, you spend on R&D, you buy back your stock. And it just becomes a self-fulfilling prophecy of, gosh, when you're performing at that level, particularly at that scale, it just allows you to keep motivating it higher because you're extending your moat you're building because you can spend more on R&D, et cetera. I will say one thing. It's come into question about whether AI and whether the returns from AI for a number of companies are going to be what they could be. And by the way, I actually think for most of them, they will achieve what their projections are. But we do know is these companies for the next couple of years that are in and around it, that are in infrastructure, cloud, semis, energy, they're going to continue to have, and the ones that utilize data efficiently are going to continue to throw that off. So, even I think next year's going to be quite different than this past year. But I still think equities will do their job because that cash flow is so high. Now, if you said to me, okay, I got it, give me on 20 stocks, 25 stocks, you can get to that place. The S&P 500, there's an extra 475. Like that's a harder call. And because they're not, as you said, swimming in those fast rivers of cash flow. And, I think you got a beginning of the year, you have an economy that's in pretty good shape, but then, you could see some headwinds building. So anyway, I'm pretty confident we'll have a decent year in equities. I think it'll be much more volatile. And, I think that quote articulately said, multiples are high, very high today and I think these big companies, you get through it because of where they stand. But whenever multiple is higher, it doesn't necessarily mean the markets go down. High multiple is a bad predictor of short-term return, but it does tell you that volatility will be higher.
You alluded to next year being a little different, perhaps. Maybe expand on that. I mean, as we look around kind of the equity landscape, there's certain areas that have lagged. I mean, healthcare, I know, has been one that's been a little beaten up. There's a lot of ink obviously spilled, as you mentioned, about some of the not giant companies. So, mid and small cap lagging again this year. Feels like I don't even know how long small caps have been in the penalty box. But as you look through the US market, are there any things that are kind of glaringly stand out in your mind?
I'd say a couple of things. One, I think it'll be a more normalized return dynamic. So, we've spent some time. I don't like small caps. I haven't liked them. And I think if you like the shows we've talked about in the past, people say, what do you think of small caps? And I like not very often because I think digital and the utilization of data is so powerful that I just think it's very hard to compete as a small cap business. However, I think there are a few things at play that could make it a bit different. One, I think you'll see M&A that will be high. So you'll see some of these companies that will get through vertical integration, otherwise will get taken out. AI does, and my partner Russ Bramack talks about this all the time, that it democratizes business in many ways. So there'll be some companies that can pivot off that, I think will do reasonably well. And then I think valuations are okay. And if we get the rate down, and we're talking about it, but if you get the rate down, you have a good economy with a lower rate phenomena, then I could see it being a more normalized condition. I still personally, my favorite sectors are still tech and, you could evolve. Like talk about I think the big ones are still in very good shape. Healthcare technology, I think, is super interesting. Is I think the world is going to, I think, God willing, I think we're going to see incredible discovery and change and evolution. Financials, I think, are still in pretty good shape. And then I think you have a little bit more balance versus some of those, what are traditional value equities. I still don't love them as the core of the portfolio, but I think you have to give them a little bit of time next year.
As we look around, the economy in general, maybe give us a broad, high level view from your perch. What do things look like? You had one quote that I thought was really interesting where you were talking about, despite equity markets being all-time high, job growth has started to turn negative. And I think you said outside of healthcare, outside of a recession. That's a pretty interesting data point to me. Maybe just give us a broad view. What do things look like? And is labor market a problem here?
I think it's a big problem. To start with, I think the U.S. economy is in good shape. Like, I think we're going to throw off close to 5% nominal GDP this year after 3 years prior that were really good. Anyway, that's good. That's good situation. I think next year you still throw a 4.5 to 5 fiscal tailwind. So I think the economy in aggregate is doing well. I think economy is generally doing well. I think companies are doing in aggregate doing great because they're cutting costs. I think people, not so much. I think we're going through a productivity revolution, and I think people underestimate, we talk about healthcare. Healthcare is not cyclical, not interest rate sensitive. I say not cyclical, it's demographically oriented, et cetera, and given age dynamics, et cetera. But we're actually seeing a reduction in jobs through healthcare. We've been running at it, post-COVID, hiring in nurses, et cetera. That's coming off. I think, though, you're seeing something that is significant, and part of why I'm so publicly adamant about, I think the Fed has to cut interest rates, is I think all the ordinary jobs are going, the lower skilled jobs are going away. And I think it's a travesty. And I don't, it's like not anybody's fault. I think that is the evolution. And it's not AI, or today it's not AI. It's productivity through inventory management, logistics, predictive maintenance, client procurement. Like, you can go across the board in every earnings report. So I think what happens is companies say, okay, my top line revenue is not growing as fast as it used to. It's still okay. But if I can keep my margins up, how do I keep my margins up? I get my cost of goods sold down. I get my SG&A down. I get my human capital lower. And so the hard part about this story, because there's so much money in higher income, in older savers, that consumption in aggregate is still pretty good. But I think we have a problem, and I think it's a social problem. I think it's something that we have to get at, and I think lower interest rates will help that. But anyway, I think that's going to be the story of the next 2 or 3 years, that we have a hard time employing the number of people that we should employ.
There's two kind of word cloud topics that I feel like dominated 2025 in the economy. And one, which I feel has faded somewhat for a long time, was tariffs. And so love to hear on kind of how you're thinking about their impact and maybe look forward. And the other word cloud that I feel like has been more and more ramping up has been about housing and the housing market and unaffordability. I'd love to hear about the lack of velocity there, all those good things. Tell me, from the economist hat you got on, where would be, kind of how you feeling about those two topics?
So I would say the first one is, I think tariffs. The U.S. economy has the highest amount of imports in the world, and is also the least reliant on trade. So while tariffs are significant, and I think the whole world, this view after Liberation Day that we're going into a recession, the question is a deep recession or not. U.S. does not rely on export-import, not nearly as much as European countries, Latin, Asia, obviously China, Asia countries, et cetera. So I think it's a near term. It impacts inflation in the near term. And you're seeing that core PCE, the Fed's favorite measures, are run at about 3. But then I think it's coming down. And I think you're going to get on the backside of this. And I think you're going to see productivity kick in. So anyway, I think it's rightly taken its place, as you described, as interesting. By the way, I think court rulings around it is a hugely important dynamic for the deficit in this country. because we're going to run over the next 10 years, 5.5 trillion of deficit, and the tariffs can make up 3 to 3.5 trillion of that. So that is super important. And so that's something we got to watch very, very carefully over the coming months. The other dynamic, which is I think you've also isolated the one, housing. People underestimate housing in this country. And I think if you go back and look at crises, the financial crisis, the early 90s, the real estate crisis, 3/4 of the wealth in the country is in people's home. And for people, on average, that's not aggregate total value. But what that means is when you have a dynamic where housing slows, you create this unbelievable pressure on the system, on people, on the majority of people in the country. I think today, I think the most important thing, and the reason why I think the rate has to come down is if we can get the mortgage rate into the mid to high fives, you start to see housing velocity pick up. And by the way, you've seen it recently as the rate has come down and existing home sales are picking up. Why is this such a big deal? Labor mobility in a period of time where labor is harder, it picks up because you can move. You can leave your existing house, take on a mortgage in a new house. 2, we put over 3 people to work for every house built in this country. You can't AI building a house, at least not generally, not today. So you put a bunch of people to work doing that, and you help young people who are, the traditional way you build wealth is through your home or unlock the value because you've had home price appreciation. And so if your ability to sell your house, a really, really big deal. I think it is the great secret of the U.S. economy is that housing is much more important than for the aggregate populace than people give credit to.
You mentioned the path of rates. I feel like we can't have you on without asking kind of broad expectations. You think down is the right way? And if certainly the 2-year would be signaling that 2 years certainly lower than where we are today. If you had to put your hat on for the next 6 months, perhaps, what would be kind of a broad expectation on magnitude and number of cuts we might be looking at?
So I think the Fed, I would say I've learned in my career that when you say something's a no-brainer, you're setting yourself up for a really, really bad outcome. But I think we got to get the funds rate to 3%. Market's pricing it. I think we should get there faster because it would create, all the dynamics, the benefits that I think are including the debt in this country. If we get that rate down, it's hugely impactful, that deficit discussion. So I think we're going to 3, and I think you could mark that down as we're going to go to 3. Markets have priced most of that in. I ultimately think that the terminal funds rate, which is obviously a big deal for the Fed, is actually lower than 3 because of what we talked about, productivity and technology bringing rate of inflation down. But I think we're going at 3. I think the critical number to watch next year, which I think is, quite frankly, the most important thing for monetary policy, is the 10-year Treasury. If we can keep it 3.5 to 4 stable, it has huge impact on funding the debt in the country, how international investors look at the currency, look at U.S. assets. Hugely powerful for the mortgage market. If rate volatility is lower out the yield curve, nobody borrows off the Fed funds rate. It's an archaic metric from years past when banks borrowed short, lent long. Nobody borrows off it. The 10-year is, get argued at the 5-year, the 7-year. It's certainly out in that part of the curve. If we can keep that stable, then markets will be okay, economy will be okay. And I think that's where we're going. And, for an investor point of view, are we going to make a lot of money in 10-year treasuries? I don't really think so. I don't think that's the game for next year. I think generally the movement is going to be to lower rates led by the front. I like the belly of the yield curve, but that's where I think we're going. But the key is stable. If we can keep them stable for the economy, it's a big deal.
You have a quote, which I pulled out because I loved it while we're on the topic of rates and fixed income, where you said something along the lines of fixed income is about getting paid back over and over again, with breadth being more important than bravado. Maybe expand on that. What do you mean by that?
This took me 40 years to figure out. Like in fixed income, the whole game is just get paid back. Like we have no upside. It's just like, can we build income and just get paid back? And, equities, the reason why I believe in this in fixed income, that the key to investing in fixed income is go broad, diversify. Don't be a hero on, I'm going to buy emerging markets versus developed markets. I'm going to buy tons of high yield, triple C's versus. Diversify, do it a billion times. It's similar to, like I always say, like running a casino. Like tilt the odds in your favor, do it a billion times, let the odds work for you. Equities are the exact opposite, where I think equities go up and they're convex to the upside. Companies build return on equity, your stock can go up. And that's why I find like long treasuries as an asset allocation. If you're going to take long duration assets, more highly volatile assets, you can buy 30-year treasuries at 470-ish, or you could buy equities where the return on equity is 20+%. Like, what would you do? Like, just buy the equities, let's say every minute. But in fixed income, the game is, and the way I run my portfolios is like, can I get you stable income? And they're in fixed. I was looking at, what fixed income? There's almost 1.5 million unique securities. You think about like how you tranche a CLO, et cetera. There's 1.5 million. Like in equities, we talk about, what are there, 30 stocks, 40 stocks? So anyway, it's a completely different game. So anyway, that's a bunch about how I think about it today.
Yeah. And so, I mean, look, you guys have been very successful rolling out some new ETFs, BINC, B-I-N-C, up over a dozen, 14 billion since launching only a couple years ago. Congratulations. Like you said, there's a lot of different things when you mention fixed income. You could have US short term or 10-year, you could have corporate or junk, you could have emerging markets, foreign agencies, on, million stripes, flavors. Any particular areas you think that look more interesting than others, and where are the landmines?
I find that most people find that fixed income is not that exciting. And so truly what I'm trying to do in bank is make it incredibly unexciting and just try but within that, it takes a crazy amount of work. So what do you do with that? You came into this year, like high yield was pretty cheap. European high yield, crazy cheap. It's not cheap anymore. So, but there are areas like we are doing a bit more in emerging markets. Dollar, dollar is going to be, I think certainly more stable to maybe lower. Although I travel around the world, the number of people that have said, I want to take some outside US interest rate exposure, currency exposure. Emerging markets, I've added some emerging markets. Mortgages, we talked about if you can keep rates stable, agency mortgages become not that exciting, but fantastic, just carry liquid, et cetera. So we've done more. We've reduced our investment grade credit because spreads are tight. I still love Europe because we get a cross currency basis, we get a swap. So, and then I still like the belly of the yield curve. Like I find other than long munis, I think are really good because of the tax adjusted nature of them in the long end. And then, I like the securitized market, not to get too detailed around securitization, but I like parts of commercial mortgage market, the residential mortgage market, so doing a bunch of that.
I hear a lot of good stuff and not a lot of landmines, man. Is that a good summary? Things look good?
No, that's because I didn't think of that. Listen, I think 26 is going to be, in particular fixed income, more alpha, less beta. Meaning, like, I just don't think I'm going to ride spreads tighter. I don't think I'm going to ride like a surfboard of yield improvement that's going to really help us. I think it's going to be, we see it today. You are seeing some of the credit quality deteriorate in some areas. We talked about lower incomes harder. So some of things like subprime auto, tough, in some of the underwritten credit markets, or some of the, say underwritten, not underwritten credit markets, some of the privates. Like I have to say, I've definitely seen a bunch more of lending and things like software, middle market. That is definitely trickier. I think 2026, we'll see not shockingly higher defaults. That is a systemic problem, but I think there are going to be more landmines. And I think, in every day we go through, and look at, been okay. We've been pretty good at deciphering the, where there are potential issues or where there isn't. But no matter what, nobody's going to get them all right. And so I think our whole game next year will be, diversify and get the income and just be super diligent about missing the potential landmines, for 3 years, 4 years. I will say something. I'm doing a presentation called The Difference Between Gambling and Investing. And I think the last 3 or 4 years, like you could just, ride it and, you can gamble. Like I think we're moving from gambling to investing.
I know you're a big sports fan. One of my favorite stats/quotes you wrote about I'm going to read and you can kind of tell me what it means to you. But you talk about over the almost 20-year career, my God, Nadal won 14 French Opens, which you said he won, and these stats are just mind blowing, 112 of 115 matches, which is a 97.4% win rate, 90% of all sets, 89% of all games within those matches, but he only won 55% of the points played. The secret, winning the important points. I thought that was such a cool description. Maybe tell us a little more about what you meant by that and also the piece you were doing.
By the way, I'm a crazy sports fan, but I studied the number one tennis player in the world. Tennis, by the way, is not my favorite sport, but I studied. Do you know the number one tennis player in the world? I studied for 20 years. As only wins 53 to 56% of the points. Meaning your number one's playing number one.
It's like a casino odds level, man, but they always win in the long run.
But they win. Okay, so here's another crazy one. Alcaraz and Sinner, and I'm not a big tennis fan. Do you know at this point, this is the craziest stat. They've played each other, I don't know how many times. They've each won 1,351 points. Exactly. Except for the big points, which is a crazy stat. And again, so Alcaraz, I guess, has won more of the big points. And so he's won the significant majority of the matches. They've each won 1,351 points. How crazy is that? Anyway, what do you do with all that other than just being a really cool stat? Part of why I relate it to fixed income is I believe in this business. So you make a little bit of money a lot of times, tilt the odds in your favor, and then just do it a billion times. And I think that is the whole gig. I don't remember. I say one thing that, I grew up, you said about sports, like I used to like, my mom would give me money for lunch and I'd like to bet it on football. But it taught me a ton about, I used to study teams, how they do in artificial turf, how do they do in domes, how do they do against, but it teaches you a lot about the odds, and you realize like if the odds aren't in your favor and you compound that over time, it's pretty darn hard to, it's part of why I believe in this thesis. If you can sort of be the house or tilt, good research, good analytics, good risk management, and just, try and just do that a billion times. But it's crazy when you think about it, a tennis perspective, because it's just, you got to be there when it's the tiebreaker, what have you.
What else is in the presentation you're giving about gambling versus investing? There's so many lessons for better or worse, but we had Annie Duke back on the podcast a while back, but talking about making the right decision versus the outcome. And same thing with markets, right? You can sit down at the poker table and make the right decision and somebody gets lucky and gets, an inside straight or something. And the reflection was, that was a stupid idea, when in reality it was the right idea. It just was the outcome that happens on occasion. And same thing with markets. Tell us a little bit more about your presentation. Would love to hear kind of any other thoughts.
Yeah. So, and by the way, I had AI help me with some of this, and it was actually unbelievable. I'm thinking through some. So come on. So I'm doing it a little bit because I'm still working on it, but there are a couple of things that are pretty, what is the difference when you gamble? You don't really own something. You own an event. And, if you're betting on the price of what a stock's going to be in the next week, you're kind of, you're betting on an event. When you're investing, if you own real estate, you own equities, you actually own something that is durable. It may be lower in price, but it's durable and it will continue to create value over time. That is different. Your time frame also becomes very different when you think about gambling versus investing. There's a finite point in time when you're gambling, usually short term, and then you move. When you're investing, you got to extend the lens of, what is your time frame that you're doing it in. And, I will say, I go through some of this per what we talked about. Like, how do the gambling firms make most of their money? It's on parlays. Well, they make the money on parlays because, don't do the math of like getting something right 3 or 4 times in a row or 3 or 4 events is almost impossible. And the odds don't reflect that. But it's a very interesting thing. It's part of why I believe in this thesis from an investing point of view. Like, you're never going to get it all right. And particularly in efficient markets, like, betting against the 10-year treasury day in and day out, pretty darn hard. Markets pretty efficient. Less efficient markets where you can really dig in and look at collateral and coverage and covenants, et cetera. So this idea that I always believe this, like if we do okay in the efficient markets, but maybe only get it right 55% of the time, but in the inefficient markets, that's where there's more alpha. And like, if we get that right 65, then you're doing okay.
You made a quick reference a little bit ago to private credit. I know that's something that, you hear a lot from the commentators. People get worried about its size, get worried about what's going on there. Is that something to get hot and bothered about, or nothing burger, or are you pretty bullish on private credit? How you feeling, or
Yeah.
don't even think about it?
So I don't have social media or otherwise, but like the themes like kind of like all move. There's like liberation, like it's a disaster, and they so I think private credit is. I think you're going to see episodic issues. I will say, I'm doing this for a really long time. The leverage, the gearing, the lack of collateral, the pick that you saw in '05, '06, '07, it's definitely not nearly as robust today. The economic conditions are considerably better. Free cash flow is just better. It's definitely not a nothing burger. Because there will be some episodic issues for sure in some of the places we talked about. But I don't think it's a seismic shock for sure.
One of my favorite things to do with investors is to kind of, because people love thinking about macro, and I always say macro is tough. I said, a couple times over the past few years, I said, what if I'd given you this information a year ago? What conclusion would you have come to? And the one I did on Twitter the other day that I thought was fun, because I think a lot of people are talking about it now, maybe because they're taking all their jewelry to the pawn shop at Christmas or something. I don't know. But I was like, we're in a year where gold and silver are up, I think, like 60 and 90% this year or something. And I said, if I was to go back a year ago and give you that piece of information, what would you in your head have thought, would be, oh, inflation's 5%, Bitcoin's 500,000, some new war, aliens, stocks down 30. I feel like people would be the assumption would be that something's not good. But the reality is inflation's mellow, stocks are up almost 20. Two of the larger conflicts going on in the world or look to be perhaps hopefully ending. Things look good. And I don't know that much of that I have a question here other than, do you have any thoughts on the precious metals? Is there anything that's signaling in the macro view of what's going on in the world, or it's just one of them things?
I learned something from a friend of mine, Paul Tudor Jones, maybe the best technical investor I've ever seen. And he has a remarkable ability to study the technicals and figure out, and he's described it, more articulately than I ever could about technicals are more important than fundamentals, certainly in the short to intermediate term. So, there are a lot of things like, when I often say, like, in particular, like when you get a payroll report and the market does crazy things, you say, thank God I didn't get the data in advance because I would have lost more money. Technicals are hugely important. I'd argue, and part of what we try and do with AI and otherwise is just like get a sense for where the crowding is, so why is gold doing what it's doing? People are globally are diversifying. Reserve managers, central banks are saying, you know what? I had dollars. I've done very well with dollars for long term. You have a different paradigm today, the debt on the United States, et cetera. I need to diversify a bit more. So I think at the end of the day, by the way, not that we have a good gold position, not because I necessarily predicted that at all. Or do I think it's a good asset to own? Silver, I think, is a lot of speculation, and I'm not an expert on it. But gold, I would say, there is going to be more and more people who say, you know what, I've had the dollar as a reserve currency. I've had the dollar. And I think when I travel around the world, I hear a lot of people that say, I'm going to hold more reserves in gold. And so I think that technical condition transcends any of the relationships to real rates, to inflation, et cetera.
Speaking of golf, how's your game? You playing much these days? Getting better, worse, in between?
I think aging has, I think actually last night, I think I've had this revelation that I'm just going to get worse. Like and I'm just not going to devote enough time to overcome the aging problem. My swing is shorter. Anyway, it's kind of depressing, to be honest, because I love doing it, at least, but
I heard a great quote from Scott Galloway not too long ago where someone was talking about just aging in general, not related to golf, but it kind of applies. And he says, look, I'm just going to enjoy getting old and gross. And I say, I can adopt that little Zen mentality, apply to my golf or surf game. It's double overhead surf out here in Manhattan Beach today. I'm too old to go to even consider getting pummeled out there. So similar mentality, but enjoying it for the mastery, idea of it.
it's like the amount of time you'd have to spend to get your short game to overcome your lack of talent and lack of lack of ability to hit the ball further. It's just not worth it.
The old game show where there was the 4 questions. I think it was Who Wants to Be a Millionaire, and you were allowed to phone a friend. We phoned one of your friends, and he was joking about you. You definitely have had some broken golf clubs over the years. So we were going to ask you, have you had more broken golf clubs, or Cliff Asness, who's another podcast guest, has had more broken monitors? But I don't know if either's gotten into the double digits, but it'd be a good prediction markets bet.
I'm convinced that release is good. I don't have broken phones over, but I think release is good. It is.
There you go.
I've definitely had my fair share of that.
We saw some pretty cool news, I think, this past week recently, where thinking about getting everyone invested in markets, you have these new baby bonds / freedom dividends / Trump accounts, Invest America, where young folks are going to have their accounts starting to be seeded that are born in the US, which I think is pretty cool. As you chat with the younger cohort, people start to do some training out of college, or even, younger than that you interact with. How do you talk to them about like getting up to speed on markets in general? Do you got any favorite books, any favorite things you've been reading, any suggestions for them in general as they start down this path that you and I both went down, as you mentioned, almost 4 decades ago, Rick? Can't believe it.
Personally, I find reading about tech people and how they think about more than necessarily investing. Although like I said, there are some good books out there, I think. But I think like if you listen to like where is the puck going and where big tech, big thinkers, the Zuckerbergs, the Bezos, Tim Cook, if I can get in the train of thought of where their heads are going and where they're investing and where they think M&A, like that to me is, I think, inspiring, A, and I think B, it helps me think through like where's the world going. I think the key to investing is everybody talks about the same thing at the same time, and it's like predicting where we're gonna be. I always say this: we're not in the business of being right. We're in the business of generating return for clients. Oftentimes, it's not being right. It's what do we have to anticipate? What will others think over the next 6 months, a year? And if you can get in, think at a different level around that, it's hugely powerful.
It reminds me of one of my favorite titles for a book was the old Ned Davis book, Being Right or Making Money. I just love the name of that book. As we look to innovation and what's going on with technological uptake, I live here in Los Angeles, and one of the things you start to notice if you're looking around is there was like 1 or 2 Waymos on the road, and then now there's like they're everywhere. And then this past week, I've started really like literally the past 2 weeks, I've started getting text messages from a bunch of friends. One of my buddies, Martin, was like, "Hey, have you tried the new Tesla full self-driving?" And I was like, "No, I don't drive that much. Also, I'm in LA. Like, I don't really trust it." He's like, "Dude, it's night and day." He's like, I haven't driven in 4 days. He's like, I just hop in. And so going to what you're talking about, like, if you don't pay attention or you're not interested, you may miss out on some of these things, but they happen quick, like the ability to change an entire economy and the way we all move and think can happen quicker than most of us recall or think.
I found, I know it's cliche. I know there was a Peter Lynch used to say, like, they used to try things out. Like I did try, I mean, I never forget it. I tried a Tesla. I'm like, oh my God, this thing is pretty incredible. I did the same with Peloton. I did the same with Apple. I remember when they opened a store near me and I'm like, my God, these things are pretty incredible. I want to be the first in line to all these things because I think it helps you. Like I've been getting involved in these glasses, the Vision Pros, the Meta glasses. Boy, I think, I saw a comment that Elon made the other day about, do we need phones in the future? Either way, I also, I used Starlink the other day, like, oh my God. Like, and, like you say, I mean, by the way, I did drive to Orlando this weekend. Actually, I didn't. I did the same thing. I hit that button. It is remarkable, but it gets to this point about jobs. Like, this is crazy. Like, you think about there's 4 million people in the United States that are employed in driving, trucking, taxi, Uber, et cetera. Like, this is happening, as you said, so darn fast.
Listeners, if you're looking for last minute gifts, Rick mentioned arguably, there's only a few items that if I lost them, if they broke, I would buy them again tonight or tomorrow. And one of them for me is the Meta Ray-Ban glasses, but not for what, if you don't own them, it's not for what most people think. Most people think you're talking to the AI, you're, doing, it's actually for two things in my mind. One is for phone calls or podcasts. So like I'll walk to work and I'll do phone calls through my sunglasses. You feel a little more in the environment than you might with the headphones. The headphones feel like they take you out of the environment, and the audio quality is actually pretty great. And the second one is if you have kids, even if you don't, for family, it's a great being able to take photos, being able to take video at sports, and it not be invasive. I mean, I'm trying to, like most of us, keep the phone off the dinner table and other places, but they're one of the few things that I would immediately buy again tonight if I sat on them this afternoon at a restaurant or something. I love them.
Agreed. I bought two because it's terrified. I mean, they're pretty good. They're pretty good. But I think trying these things out, it's a big deal.
So as we start to wind down here, we only got a few minutes left. As we look to the horizon, 2026, it's hard to say. As you look out to next year, is there anything we didn't cover today that's got you worried, got you excited, got you confused, that you think is something that investors should think about or consider for their New Year's resolutions?
Well, I think you got to retrain your brain into next year. I think, I was saying to our team today, the last few days, like we haven't thought about shorting of any signal. We generally, most of our portfolios are long only and create better portfolios for people. Like shorting's going to work. I think we have a different dynamic coming where, again, I think economy will be fine. I think companies will generally be fine, but I think it's going to be, volatility will be higher. I think they're going to be, the evolution of AI, of technology, they're going to be winners. There's going to be who uses data effectively, and then there won't be. And so I just think we got to retrain our brain. Well, you could argue, like people say, the easy trade was, by the way, I never find the easy trade was an easy trade. Like in retrospect, like got it, maybe it was. It's always, maybe it's just me. It always seems hard. But if you believe that the last few years, it definitely was easier because things trended higher. You had a huge blanket of fiscal monetary stimulus. That is, you still have some of that in the beginning of the year, but I think we're going to see very different 2026. By the way, it's not bad. I'm more pumped up for 26 than I've ever been. It's not bad. I just think it's going to be, you just got the tools you use are going to have to be a bit different.
Yeah. Well, you're going to potentially have a lot of tools at your disposal, maybe being the next Fed chair. Rick. We'll see. I don't know. Either way. It's funny, though, as you mentioned, the easy money being made. There's always funny things you hear on TV. So this is a challenge to you. Maybe I'll try it the next time you go on TV, on Bloomberg or something. Say, look, the hard money has been made here. Or just flip the script and just watch the journalists be like, what are you talking about? Be like, look, the really hard blood, sweat money has been made here.
I have to tell you, when I hear it all the time, that was the easy money. I don't know. I come in every day. Nothing was like, oh, there it is. Like that. Oh, like, I don't know. I don't think any of it's easy. I think you got to work hard.
No, the investment graveyard is large and growing. Rick, this has been a blessing. It's fun as always. Thanks so much for joining us today.
Thanks for having me on. I always appreciate it.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.